Money is changing. The way we earn, it is changing. The way we spend, it is changing. And increasingly, the way we invest, it is also changing. From seasoned investors looking to fine-tune their portfolios to young professionals making their first investment, the questions are surprisingly similar. Where should my money go? How much risk should I take? And am I actually making the right financial choices? Today, investing is no longer limited to a select few who understand complicated market jargon, with technology putting markets at our fingertips. More and more people are taking charge of their financial future. But easier access doesn't always mean better decisions, because whether you are making your first investment, building a diversified portfolio, planning for retirement, or simply trying to make your savings work harder, every financial decision comes with a question of risk, return, and timing. So what does it really take to become a smarter investor? Because after all, personal finance isn't about how much you earn. It's about what you do with what you have, and that's exactly what the Money Show is here to help you figure out. I'm Kavita Thapliyal, and this is your show where you can participate. We can help you make a financial portfolio for yourself. You can take our experts' help. So just scan the QR code that's flashing on the screen. You can also email us your questions, and we will do your life financial planning on the show while explaining you everything about your financial goals and the strategies you should be opting for. And for today's show, we are joined by a very special guest. This is Mr. Ajay Tyagi of UTI AMC. Ajay, hi, good evening. Welcome to the show, and so nice to see you after such a long time. How are you doing?
Very well, Kavita. Thank you. Likewise, good to see you as well. And thanks for inviting me on your show.
Lovely. It's going to be a longer session today, Ajay. But before I start putting up my questions to you, there is a latest data that's released by SEBI. And I'm sure you're aware of it. But let's just inform this data to our viewers, and then I'll come back to you, and then we'll take the questioning ahead. Ajay, so let's talk about this very important data. This is mutual funds in FY26. Which category took the biggest hit? That's right. The headline from SEBI's latest data is striking. The number of mutual fund schemes delivering negative returns in FY26 increased almost threefold, from 243 schemes in FY25 to 731 schemes in FY26. But the bigger question for investor is, which types of mutual funds were actually hit the hardest? And when we break the numbers down, one thing becomes very clear. The pain was not evenly distributed across the mutual fund universe. First, technology funds. Among the biggest casualty, technology and digital-focused funds were among the worst performers. Now, in an analysis of almost 556 equity mutual fund schemes for FY26, if we look at Quant Tech Fund fell around 47.2% on SIP investments, while Motilal Oswal Digital India Fund fell around 35.4%. Other technology-focused schemes also saw steep declines. HDFC Technology Fund almost down by 31.8%. Tata Digital India Fund 30.1%. Aditya Birla Sun Life Digital Fund 29.6%. Now, these numbers show just how painful a concentrated sector bet can become when that particular sector goes through a correction. Second, small cap funds, another major pressure point. Small cap funds also had a difficult FY26. For example, Tata Small Cap Fund was down by about 32.6% on SIP investments during the period analyzed. Now, at the category level, small cap funds were among the weakest performers, with the average one-year SIP return around 15% as of 25th March 2026. Now, this is particularly important because small cap funds had become extremely popular with retail investors after delivering very strong returns in the preceding market cycles. The lesson here is very simple. The category that delivers the biggest returns in a bull market can also deliver some of the biggest drawdowns when the cycle turns. Now, the third category is flexi cap funds, negative but relatively more diversified. Now, flexi cap funds were not immune either. Clearly, the average one-year SIP return for the category was around 14% as of 25th March 2026. But there is an important distinction. A flexi cap fund can move between large, mid, and small cap stocks. That gives the fund manager more flexibility than a fund locked into one segment. So while investors did see negative returns in FY26, the category shouldn't be treated in the same way as a concentrated technology or a thematic fund. In fact, flexi cap funds remained extremely popular, with investors attracting nearly 90,000 crores of inflows during FY26, according to a lot of data. Now, large cap funds, even the relatively defensive category wasn't spared. Large cap funds are generally considered the more stable part of an equity portfolio, but FY26 was difficult even here. The average one-year SIP return for large cap schemes were around 14%. Now, that tells us something very important. This wasn't simply a small cap correction. There was broad pressure across Indian equities. So, an investor who moved entirely into large caps, expecting them to be completely insulated from volatility, would also have been disappointed. Now, multi-cap funds also under pressure. Multi-cap funds, which was required to maintain exposure across large, mid, and small cap stocks, also saw weak short-term performance. The average one-year SIP return was around minus 13%. And again, diversification helped to spread the risk, but it could not eliminate market risk. Now, if all three market cap segments are under pressure, multi-cap fund will inevitably feel some of that impact. So, where was the maximum damage? Now, if we have to put this in numbers together, the picture looks something like this. We'll put on the screen as well. Technology/digital worst hit. Individual schemes were almost down by 30 to 47%. Small cap average one-year SIP return around down 15%. Flexi cap one-year SIP return around 14%, and large cap average one-year SIP return down almost 14%, and multi-cap again around 13%. So, what's the important number here? The important number over here is, out of 556 equity mutual fund schemes analyzed for FY26, 486 were in negative territory and only 70 delivered positive returns. That means the story is much broader than simply saying small caps fell. It was a difficult year for Indian equity mutual funds across categories. But what should investors make of this? The first mistake would be to look at these numbers and say, my mutual fund is down, therefore I should stop my SIP. That's not necessarily the right conclusion. Instead, investors need to distinguish between a diversified fund going through a market correction versus a concentrated fund suffering because its particular sector or investment style has fallen out of favor. As we saw in a technology fund, carrying concentrated exposure to IT and digital companies can fall dramatically, even when a diversified flexi cap fund falls much less. And this is why category selection matters, such as, having a fund selection of that sort of. But let's just sum up this up. And Ajay, I'll connect with you now. Definitely, we will not talk about individual schemes, but whenever you and I have a conversation, Ajay, we have always helped our viewers understand the purpose of diversification. And this report sets the right example for our viewers to understand how a mutual fund or a diversified mutual fund works.
Absolutely, Kavita. And I will start this conversation by making a statement which has been, a guiding pillar for me all of my career, which is that reversion to mean is one of the most potent, I would say, phenomena and mechanisms of financial markets. What you see as, one of those schemes which have been right up the charts and, in fact, bursting the charts could well be the underperformer of tomorrow. And what you presently see as the scheme which is lagging all through over the last couple of years could actually turn out to be, the rock star of tomorrow. So this keeps happening, and that is why we say that investors have to diversify their portfolio very, very well. And when I say diversification, it has to be along a few things. Just to simplify, I would say the first diversification, which we very well understand, is along the market cap axis. So you make some investments into large cap schemes, into mid caps, and also into small caps. Like you mentioned, flexi caps typically would have, a fair bit of allocation across all of these three segments. So in order to gain diversification across the market cap axis, you could choose some proportion of large, mid, small, flexi, and multi. Now that's one. In addition to this, and before I come to the other axis, which is the style axis, I should say that the market cap axis has been traditional way to diversify your investment. So we've known this for the last 10, 15, 20 years that one should kind of make allocations into different market cap buckets. But I think what's equally important is the style axis as well. Broadly speaking, we have growth oriented schemes on one side, we have the value oriented schemes on the other side, and we have what we call as a blend or a core style, which is an amalgamation of these two extremes, that is, value and growth. Now, it's very important for investors to also understand that not all large cap schemes, if we assume that large caps are doing well, will do equally well, because it is entirely possible that large cap value schemes have done poorly, whereas large cap growth schemes have done very well over the last few years. If at that point of time you come out of your large cap value scheme, you possibly are taking the very wrong decision, because, like I said, it is entirely possible that after 3 years of growth as a style very doing well, value can come back into focus. And therefore, your allocation into large cap oriented scheme, which was run along the value style, could just be about turning around in terms of performance. So yeah, just for setting the tone of this conversation, I would say investors ought to remember that reversion to mean is very, very, I would say, important phenomena of the stock markets. Uh,
Absolutely.
you know, that you have to keep in mind. Therefore, to weed out your laggards, uh, uh, is an important thing, provided you have understood that why is the scheme lagging and why you ought to be taking it out and investing into something else. Yeah.
All right, perfect. So I think we have set the right tone for our conversation ahead. So I also want to understand now how is the market placed according to you from your lens, the current trajectory of the market. Q1 results so far have supported the market. What will you say?
Absolutely. I would say after many, many quarters, we've
Yeah.
seen a quarter which has been more surprising on the positive side rather than on the negative side. I mean, if I were to do nitpicking, there would be very, very few sectors or companies which would have disappointed us. In general, this was clearly a very solid quarter. And please bear in mind, this quarter did have the impact of the war. The
Right.
earlier months of this quarter, particularly April and May, at least the first half of May, did have an impact of the war, and we all know that the consumer sentiment during those months was weak. Notwithstanding that, we've seen very solid numbers, which basically tells us that after two bad years, FY26 and FY25, where we had mid-single digit kind of earnings growth, FY27 could well be mid-teens kind of growth for us. Yeah.
Right. Let's start talking about sectors. I've read a lot of your interviews. Every time you appear on a channel or you write a column, you have aggressively defended being overweight on Indian IT services sector. Now, even amid fears of global tech spending freezes and AI disruption, I want to understand, why do you believe IT budgets will remain resilient enough to drive the structural growth here? What's the rationale?
Kavita, it's not too difficult to understand. Possibly we would have discussed this,
Right.
one of your previous. We are living in what I call as the technology age. You see, just like we had the Stone Age and the Iron Age and the Bronze Age, I have absolutely no particular, I would say, doubt in my mind that over the last 40, 50 years, we've been living in a technology age, which to my mind, at least for the next few decades, would remain so. Technology investments will remain center stage. If organizations, commercial organizations, have to do well, they will have to get their tech strategy right. They cannot, have a right to win. They cannot hold a leadership position. They cannot improve their market shares and also their profit shares without the requisite investments into technology. So that's the overarching hypothesis that we continue to hold here at UTI. And from that perspective, when valuations for many of these IT services firms have tested their previous lows, And I would say that it's been twice in the last 20 years that we have tested these lows, once during 2008-9 during the financial crisis, and the next time was during 2016-17 when there was a scare about the cloud related technologies eating the lunch of Indian IT services companies. I would say a very similar phenomena has played out in the last possibly 1 year, where the overarching fear is not the tech budgets. By the way, the overarching fear is that can AI eat the lunch of Indian IT services players? And our short, reply to this is that Indian IT services will benefit rather than actually, see their moats getting damaged because of AI. Yeah.
All right. I want a status update on this particular question because your quality growth schemes have historically maintained a negative stance on heavy cyclicals like metals, oil and gas, real estate, and infrastructure. Given the massive capital expenditure boom in India, are you missing out on near-term tactical alpha by completely avoiding these sectors, or you have started taking exposure in small chunks?
Kavita, let me make a statement first before I directly go to your question on our quality growth oriented funds. So first of all, here at UTI, we run our schemes across the spectrum. So we have value oriented schemes, we have growth oriented schemes, like I, mentioned earlier on. We also have schemes which are a blend, which basically means a mix of these. Now, each of these schemes actually construct their portfolio as per the objectives that have been set out for these schemes. So, obviously, a value oriented scheme will have exposure into the power sector and into the oil and gas sector and so on. But a quality and a growth oriented scheme would be unable to find businesses coming from these sectors and industries because most of these businesses from the sectors that you just mentioned, unfortunately, do not display high quality economic characteristics. They don't display high return on capital. They don't exhibit, strong balance sheets with strong cash flow generation. And it's only obvious that anybody who's running a strategy with a quality tilt would be unable to basically, have businesses from the sectors like oil and gas or power or metals to be part of their portfolio. So yeah, so that's the reason why some of our schemes would lack companies and businesses from these.
I do have more sectors to ask you about, but then it's time for a short break. And once we come back, we'll be focusing on healthcare and also specifically UTI FlexiCap Fund. More coming up after the break. Welcome back. You're watching The Money Show, and we are in conversation with Ajay Tyagi of UTI AMC. Ajay, hi, welcome back. And let's put the spotlight on healthcare. Now, while you are comfortable with healthcare, you have a lot of time flagged recent valuation discomfort in the pharma export space over potential US tariff structures. What is the current view? Are you shifting capital from global pharma towards domestic hospitals and diagnostics instead?
That's true, Kavita. In fact, if you take a slightly longer term view, I would say there certainly is much more value in the domestic facing healthcare names, whether it be the diagnostic companies, whether it be the hospitals, whether it be the pharmaceutical companies. So clearly, to our mind, there is more, runway for growth in the domestic facing names. Look, the US generic companies, as we know them, certainly are always under pricing pressure. So that part of the market has become fairly commoditized anyway. And on top of that, you have this overhang of tariffs. Let's assume that the tariffs don't happen because it's obviously not so easy to bring the generics under tariffs because the cost of these medicines in the US will go up significantly. But even otherwise, our very clear tilt and preference has been for domestic facing names. On the export side, I must mention that what we do like are the CDMO players or the custom, research, development, and manufacturing organizations. These are typically firms which partner with the big pharma companies for their early stage R&D, drug development, and once these drugs commercialize, They also do manufacturing for the big pharma. So on the export side, that's clearly the preference for us. Yeah.
Domestic healthcare names. Now, the next question is something very important for our viewers to understand, Ajay. Your portfolio turnover ratio is incredibly low, often under 10%. So now, in a hyperactive trading environment, which we all are in right now, what would you like to tell our viewers and explain, how to ignore short-term prices movements and to focus strictly on long-term compounding, because this is the time when one should be doing that?
Kavita, once again, this is an excellent question, but this, to my mind, goes towards the complete genesis of investments. It also goes to the entire genesis of common stock investing, which started 200 or 300 years back. I think somewhere along the route over the last couple of centuries, people have started, thinking about stocks as able to make quick short-term money by constantly moving from one stock to the other, from one sector to the other, and so on. Quite honestly, if you ask me, the real idea of wealth creation by investing into common stocks is to identify businesses which you understand well, where you think you have a particular edge in terms of understanding what the outcomes of these businesses would be over the next 3 and 5 years. Wait for the right time when the valuations appear good to you, and then invest in them. But most importantly, stay invested for a bloody long period of time. So I think that, if you ask me, ought to be the core rules around investments into the markets, whether it is direct stock investing for many investors or it is investments via the mutual fund route. You ought to actually take a fairly long term view of businesses that will create economic value. But the most important thing is your ability to hold on to them. I keep hearing about these debates about what's your entry strategy, what's your exit strategy. Nobody talks about what's your holding strategy. To my mind, that's the most important thing. And at UTI, we certainly have a very, very long term lens through which we analyze businesses, and that gives the portfolio turnover ratios for many of our funds to be very, very low. Yeah.
All right. So since you mentioned the holding strategy, one of your strict rules, you do not buy any business that fails to generate a return on capital higher than its cost of capital over a full cycle. I want to understand the rationale behind this rule, and has this rule forced you to exit popular new age tech or consumer disruptors that are burning cash for growth?
Once again, that's a great question, Kavita. Let me start with why is this rule important?
Right.
I would say every business has a cost of doing business. I want to very simply put this. Suppose you are starting a business with no capital of your own. We are just taking a theoretical view, which is at one extreme, and you borrow capital from the bank at 12%. Unless until your business generates 14, 15, 16% kind of return on the capital that you have borrowed from the bank, you won't be actually able to repay the interest, let alone the repayment of the principal that will happen after a few years. So therefore, while it's not visible to the naked eye, but the fact is that every business has a cost of capital, has a cost of equity. Unless until that business is able to generate returns higher than that cost, that business is not generating any economic value. Sooner or later, that business will have to fold up or will have to be bought out. So that's the rationale behind having a very, very strong and sharp view around the sustainable return on capital of businesses. The second part of your question was, what do we do with these new age companies which are not generating enough returns? Well, the answer to that is that since many of these businesses are in their infancy, are very, very early in their life cycle, it is obvious that most of them would be not creating profits. But the more important thing is,
Right.
can you visualize a path towards profitability? Can you look at the breakup of their business to see
Right.
that these are the two or three levers because of which return on capital can increase in the next few
Sure.
years? If the
Sure.
answer to that is no, stay away. If the answer
Okay.
is yes, they can, those are the companies that should be on your radar. Yeah.
All right. One last question. I want to squeeze this. My director is telling me the time is up, but I really want to talk to you about UTI Flexi Cap Fund. It has been underperforming. What would you tell to the investor holding this fund?
Kavita, all I would say is that, look, we have been very, very patiently holding on to the portfolio, which we think is a portfolio of winning businesses. Unfortunately, over the last 3 to 4 years, the market has completely rewarded, the value style, and it has equally punished the quality and the growth style. Like I said, reversion to mean is something which is a certainty. It is not something which may or may not happen in the future. We are certain that reversion to mean will lead to the quality and the growth style coming back in focus. And when that happens, our portfolio is sitting right there to take a ride on that. So that's what I would say. We are more focused on buying the right kind of high quality and high growth businesses. Sometimes the market doesn't reward that, but we just have to accept that very patiently and still hold on. Yeah.
All right, so reversion to mean is a certainty. Now, that's the word, and thank you so much for taking your time out for our viewers today. Always pleasure speaking to you, Ajay. Thank you. All right, with that, it's a wrap on this edition of The Money Show as well. But if in case you want any fund-specific information or want any investment strategy, do scan the QR code that's flashing on the screen, and you can also email us your queries. We are here to do your life financial planning on the show every day.